So you're someone who is finally confused and tired of dealing with your emotions when it comes to investments,
and you want something that works consistently in any investing environment.
You want to be at a point in your life where you don't ever need to think about losing half your wealth, and you want to be protected from global panics for the next 50 years of your life. Well, I may have the solution for you. Let me introduce you to the all-weather portfolio. It was created by Ray Dalio, a billionaire portfolio manager for the world's largest hedge fund called Bridgewater. The all-weather portfolio is essentially your one-stop shop investment strategy, so you can relax knowing you'll never need to worry about your life savings being vaporized. Stay tuned, because I'll be showing you its past performance versus the stock market and against the recent coronavirus pandemic, what's exactly inside the all-weather portfolio, and the knowledge you'll need to make it yourself and let it work for you. I'll also be giving you my take on the whole strategy if you want better results. Don't worry, it will all be pretty easy to understand. But before we start, smash the like button and subscribe to my channel. Let me know in the comments below, what's the biggest price drop you've ever seen from your investments? For me, it was around 80% with NOKIA. It was dark times, and the stock was getting steeper for 12 months straight. But luckily, Microsoft came in to save me when they made a deal with NOKIA for their phones. First things first, so how has the all-weather investment portfolio performed in the past? Since March 2006 to February 2020, a $10,000 investment would have grown to almost $28,000, which is a growth rate of 7.6% per year. In its best year during that time, it grew 18%. In the worst year, it only lost 3%. At the maximum drawdown, which means at its worst ever swing downward from the peak point to the trough point, it only lost 12%. This big swing was during the financial crisis, which was the worst of all market drops. So the all-weather portfolio held itself pretty well, all things considered. Actually, when the year ended, the all-weather portfolio came out positive and made money, whereas everyone else lost. How does this compare to the total stock market performance over long periods of time? During the past 14 years, the broader stock market average, which is the red line, would have gotten slightly higher performance. However, when times were tough, the stock market average punished severely to a point where most people would fall into depression or anger. Let's see the other important numbers. At its worst year, it was a 37% loss, and the maximum drawdown was a 51% drop. For the sake of your emotional well-being during these bad times, I think that most people would agree that they would be willing to have slightly returning performance over time instead of having constant fear of losing half their portfolio in any instance. So it makes sense for most people in this case to focus on playing defense while consistently having a fair level of offense over time.
Come and get them!
Let's test the all-weather strategy against something recent and powerful like the coronavirus. So when did the stock market really get ripped on? It started February 20th to today of March 12th. During this crazy roulette kind of month, the average stock market portfolio lost 27%, while the all-weather portfolio only lost 6%. So the all-weather portfolio still works even as we're experiencing new crazy developments and epidemics around the world. Okay, not bad. Although we're giving up a bit of our offense, that's a pretty good defense I think most people would prefer. So what's inside the all-weather portfolio? The strategy consists of these 5 listed portfolio components to help you make money in any environment. More specifically, these 5 investments combined should benefit from both good and bad economic and inflationary situation. To implement this strategy, all you need to do is buy them. Make sure that they're the only 5 investments in your portfolio, and then have them at their suggested allocation weightings. For instance, if your portfolio is worth $10,000, then you should roughly have these amounts of each. Because investment prices fluctuate all the time, it's recommended that these weights are rebalanced at least once every year. So for instance, if your portfolio stayed at $10,000 next year, and the values of these 5 components didn't match the allocation, then it's recommended that you sell the overweight names and buy the underweight names to rebalance the portfolio. So what exactly are these 5 components? I'll briefly tell you. The Vanguard Total Stock Market ETF helps you have an exposure to owning a piece of the world's largest businesses, and your investment grows as long as those businesses grow. I think of this component as the weapon for a Spartan. Performance in the long term mostly comes from here. A $10,000 investment with this component only during this time frame would have grown to $31,000. With both the iShares 20-year and 7 to 10-year Treasury Bond, you're essentially lending money to the US government over a long duration of time. This is the shield for a Spartan. When times are tough, you can expect your money to be protected and give you some support. A $10,000 investment with the 20-year version would have grown to $27,000, and with the 7 to 10-year version, it would have grown to $20,000. The Invesco DB Commodity Tracking ETF is just a basket of 14 of the most important physical commodities in the world, such as gold, crude oil, gas, wheat, sugar, corn, soybeans, copper, aluminum, silver, and zinc. This is the cape for a Spartan. It's meant to make you feel warmer and look cooler. It holds you back, and I noticed that it gives you worse performance.
Splashdown, sucked into a vortex. No kicks.
A $10,000 investment would have declined to $6,500. The SPDR Gold Shares ETF just tracks the price of gold without you having to physically own the gold. Gold is great against high levels of inflation and when there is major fear in the world. This is the helmet for your outfit. It looks pretty and mainly plays a defensive role, especially when every country is printing free money. A $10,000 investment here during that time frame grew to $26,500. If you're someone who's curious about the data of how the all-weather strategy has done in the past, here's a table showing how it has done since 2007 and every month since. You'll see the annual returns on the left. You'll notice that it was only down for 2 of those years, and it wasn't down too much. You will also notice that every month, you won't expect any really crazy movements in the double digit. So what are my thoughts about the all-weather portfolio? After checking out the 5 components, I found that I'm not a fan of the commodity tracker because the long-term performance hasn't shown any evidence of consistent growth and it just has very short bursts upward that don't last very long. Since its primary purpose is to play defense against higher levels of inflation, I think it makes just as much sense to get rid of this component and just combine its weight into the gold part. So I was curious to see what happens to the all-weather portfolio after it is revised. What ended up happening is that the performance was much better all around, which is the red line over the blue line. Here's the actual data. You would have made more money with a slightly higher growth rate. Your best and worst year was better, and the max drawdown was lower. When we throw in the stock market average too as an additional comparison, this revised all-weather portfolio is a better option for a good defense and offense. So that's all for knowing about the all-weather investment portfolio. Again, remember to smash the like button and subscribe to my channel. Let me know in the comments below what's the biggest price drop you've ever seen from your investments.